Hello everybody, welcome back to another valuation investing video, and today in this video I'm be going over Fiserv stock, in which Fiserv has had a rough 2025 in which the stock is down over 30%, in which I'm be analyzing Fiserv stock and going over the business as a whole, and then I'm going to be looking at the financial health of this company using my 7-step stock analysis, and then finally I'll be using my intrinsic value calculator, which is the most important part to value the stock to see at what price I'd be willing to pay for Fiserv stock and to see if we should be buying today after this huge dip in stock price. So that being said, like I said, the stock is down about 35% year to date, and taking a look at all-time highs back in April, the stock is down almost 50% since that date. So this stock has had a really rough 2025 in which Fiserv, if you didn't know what Fiserv does, Fiserv is a global provider of financial technology and services. It primarily helps businesses and financial institutions manage payments and move money, connecting them with consumers. So this company is kind of like a Visa and MasterCard, but they're more of the middleman, in which they manage the payments and money that connects them with consumers. So they're the middleman between a bank or institution and the consumer or business. And taking a look at the key operations of Fiserv, we can see they have the payments operation, where Fiserv facilitates various payment methods, including card processing, mobile payments, and real-time payments. They also have digital banking, where they provide technology for banks and credit unions to offer digital banking services to their customers, also merchant solutions for businesses, and they also have core processing for financial institutions. And finally, they have e-commerce, where they provide tools and services for businesses to manage their e-commerce operations, including payment processing and fraud prevention. So in essence, Fiserv acts as a behind-the-scenes technology partner for financial institutions, businesses, and even fintech companies, enabling them to move money efficiently and securely. And taking a look here, these are the products that Fiserv actually offers right here. They offer Clover, which is basically an open business platform, which is for businesses. Also, they have Carrot, which is for commerce. And they also have FinExact, where it's for commerce, cards, and ATMs and stuff like that. And they also over here have First Vision Optus, which is also for accounting, loyalty, and payments. So they have a large variety of products, and I'd actually like the business model of this company because it's kind of recurring revenue for this company. As long as people continue to be paying with Fiserv, they're keep going to get revenue and more money over time. And taking a look at Fiserv's biggest clients, we can see their biggest clients include banks, credit unions, financial institutions, and businesses of all sizes. So they provide banks with core banking platforms. They also provide credit unions with helping them manage accounts, process payments, and enhance member experiences. Large financial institutions, where they provide for the largest financial institutions, including core banking modernization, digital banking, and payment processing at a scale. And they also help businesses, whether it's large enterprises or small businesses. So this company is well diverse with their client orientation, and I really like that about Fiserv, because if one client stops using them, then there's still a lot of other segments with their revenue. And taking a look at their latest quarter's earnings, we can see why the stock has really been underperforming. We can see while the EPS normalized actual did beat by 4 cents, the EPS gap earnings actually missed by 5 cents at $1.86. Also, the revenue missed, with reporting $5.2 billion in revenue, missing by $3.25 million. And taking a look at the upcoming quarter's earnings, which is going to be reported on October 24th, we can see that the EPS normalized estimate is supposed to be $2.66, and the GAAP EPS is expected to be $2.11, with the revenue estimate of $5.38 billion. So I actually like that this company is expected to grow at a pretty decent rate between these earnings per share and even the revenue. Although the revenue isn't expected to grow that fast, the earnings per share is actually expected to increase by a good margin just with the quarter-over-quarter growth. But I would like to add EPS revisions right here. Only 3 analysts have increased their EPS estimates, while on the other hand, 21 has decreased their estimates. So that's kind of not a good thing for Fiserv, but I would like to add that this growth rate is still so fast that it's not even that big of a worry to me. Even if they miss by a little bit, going from quarter over quarter from $1.86 to $2.11, if that does occur, that's still really good growth out of this company, in which with their company guidance for quarter three of 2025, they actually said that they had 16% increase in adjusted EPS in the second quarter and 8% adjusted in organic revenue growth. So their EPS is growing twice as fast as their revenue because of their profit margins increasing. So also the operating margins expanded by 120 basis points to 39.6%, which makes sense why the EPS is growing at such a fast rate. Also, they had a lot of strong free cash flow of $1.2 billion for the quarter. The company also returned $2.2 billion to shareholders by repurchasing 12 million shares, marking a 26% increase from quarter one. I would like to add, I really love buybacks, but I will get into that later in the video why I think this might not actually be the best idea for this company to be buying back so much. But nonetheless, we can see that they revised its full year organic revenue growth guidance to approximately 10%, citing slower than anticipated rollout of strategic initiatives and macroeconomic factors. So they are expecting a slight slowdown in that revenue, in which they did cut their guidance by a little bit. And also the company did maintain 3.5 billion Clover revenue target. And like I said earlier, this is the open business segment of the company, and they actually said they're increased its share repurchase guidance to approximately 130% of free cash flow. So that's actually worrying to me that they are actually increasing the share repurchase by that much, but it could be a good idea, especially with the stock down so much. And also the merchant solutions segment saw a 9% organic revenue growth. The financial solutions segment experienced 7% growth. So the call highlighted several strategic initiatives, including the expansion of Clover into international markets and the introduction of new products such as FIUSD stablecoin. So this company is getting into stablecoin, which could actually be helpful in the future, especially if the US economy turns to stablecoins. And taking a look at the highlights of that earnings, like I said, they had strong revenue and earnings growth, significant shareholder returns, Clover revenue growth, and strategic partnerships and acquisitions, where they actually had a new partnership and acquisition were announced, including the agreement with TD Bank Canada and the acquisition of a portion of TD Bank's existing merchant processing business. So this company has been acquiring a decent amount of companies to help diversify Fiserv, which I like. But some lowlights was the guidance adjustment. Like I said, they decreased that to about 10%, and merchant solutions margins declined, slower implementation in banking. So this is some lowlights of Fiserv, but honestly, the earnings still wasn't too bad to me. I personally think that this recent earnings was actually still pretty solid for Fiserv. But taking a look at this was one of the biggest acquisitions that Fiserv has ever had, in which they acquired in 2019 First Data in a significant all-stock transaction that was valued at $22 billion. So like I said earlier, why I didn't like the share repurchases is because they have a lot of debt, and the main reason for this debt is because of this acquisition in 2019. But I don't think it's necessarily a bad thing, because they did buy a pretty decent company to integrate into Fiserv as a business, in which the acquisition was an all-stock transaction where First Data shareholders received a fixed exchange ratio of 0.303 shares of Fiserv common stock. Also, after the merger, Fiserv shareholders own approximately 57.5% of the combined company, while former First Data shareholders owned about 42.5%. And the reason Fiserv actually did this merger was driven by the desire to combine two highly complementary businesses. So Fiserv, with its strength in core account processing and digital bank solutions for financial institutions, gained First Data's major assets in merchant acquiring, including the popular Clover cloud-based point-on-sale platform. So like I said earlier, as we saw, they expected Clover to be growing at 30% each year. So this acquisition actually seems pretty good for the company. Even though they added a lot of debt, they did acquire Clover, which has really helped this company grow and diversify their business. And also this could offer a more comprehensive range of solutions from banking processing to merchant services, e-commerce, and integrated payments. But like I said, with the amount of debt this company had, with this acquisition, they had a significant debt load of around 17 billion that stemmed from a previous leveraged buyout of First Data by private equity firm KKR and Company in 2007. So Fiserv planned to refinance this debt and use the combined company's free cash flow to pay it down. And like I said, once again, with them buying back so much shares, I'm kind of worried that they're not really paying off as much debt as I think they should. They should be paying off their debt. They should focus more on paying off debt than buying back shares. I'm not opposed to them buying back shares, but I think the rate they're buying back is a little bit too high, because taking a look at the 7-step stock analysis where I get my key 7 metrics for the financial health of the company, look at the buybacks they're doing. They're buying back at 4% each year, which is very fast, especially for a company with a decent amount of debt right here with a 115% total debt to equity ratio. But first, let's look at the key metric of the PE ratio, which is greater than 0 at 23. So this company is profitable, meaning they are making money each year. And I do actually like this valuation because the market right now, I think, is at about a 28 PE ratio. I'm not sure. It's in the high 20s. So right now, it's trading at a lower valuation than the market, which is pretty interesting. And what's also very interesting is the forward PE ratio is expected to be 13. This is a very low forward PE ratio, especially compared to this PE ratio. Normally you'll see a few points lower than the trailing PE ratio, but this means that analysts expect the EPS to grow by a very fast rate in the future, in which the earnings per share is supposed to grow very fast, which is probably because of the share buybacks and also with the organic earnings growth. And taking a look at the revenue growth and earnings per share growth over the past 5 years, this is very fast growth with 15% revenue and 29% earnings per share growth. So this is still a very fast growing company. Also, the expected EPS growth rate for the next 5 years is supposed to be 15% by analysts. So that's pretty interesting to me. But my biggest concern is the debt, because we had 6 out of the 7 check marks, but this debt is a bit high where they have more debt than their equity. And taking a look at the total debt right here, we take a look at the balance sheet. The total cash, they only have about $1 billion in total cash, but taking a look at the total debt, they almost have $30 billion in debt. So looking at it this way, it looks very bad for this company, but to be honest, it's not that bad because the free cash flow is near $5 billion. So to pay off all this debt, it would take them about 6 years. While that's not really good, it's not bad. So it's not the worst balance sheet I've ever seen, that's for sure, but it's still not amazing. Normally, if you want to see a decent balance sheet, you need to have it less than 5 years to pay it off with the free cash flow as of right now, but they are still expected to grow this free cash flow, so it's honestly not too bad for Fiserv. So with that being said, I'm going to be taking a look at my intrinsic value calculator, but first I have to use revenue and profit margin projections for the next 5 years. So I'm just going to take a look at the past metrics of these two to get us a good idea of what's actually happening. And like I saw with the revenue, they were growing at 15% on average. However, over the past 4 years, it's really slowed down from that 15% because in this time period, we saw a lot of growth of almost 100% because of the acquisition of First Data. But with the real growth of this company, it's anywhere from 8 to 10%, but it's mainly 10% revenue growth over the past 4 years since about 2021. So the real revenue growth is 10%, but over the past 5 years, it was 15% because of the acquisition of that First Data company. So that is kind of over exaggerated from the 7-step stock analysis. But taking a look at the profit margin, we see it's increasing every year from that acquisition of First Data Corporation. But before that acquisition, Fiserv actually had a lot higher profit margin, and it was over, I think, 20%. but since then they have recovered and started to get back up to that area. Right now they're at about a 15% net profit margin. So with that being said, taking a look at my intrinsic value calculator, I have to determine the annual revenue growth rate that I think this company will grow at over the next 5 years. So with that being said, analysts expect this company to grow at 15% earnings per share. So with that being said, the revenue is definitely going to be lower than 15%. And over the past, say, 5 years, this company, its real revenue growth rate was about 10%. So I believe a bear case for this company could be 7% each year. The base case, I think 9%, because they just grew about, they're expected to grow at about 10 or so percent over the next year. So base case, I think it slightly decreases in the next 5 years to 9%. In the bull case, I think 11% annual revenue growth rate for Fiserv. Now taking a look at the future profit margin, like I said, right now they're at about 15%, but it has been increasing over time at a pretty decent rate and going up about 100 basis points each year over the past 5 years. So with that being said, I think a bear case, we could do 14%. Base case, I think 16%. I see them increasing this up by 100 basis points in the next 5 years. And then bull case, I think it gets up to an 18% profit margin. So now going back to these slides to get us a good idea of the next two things I have to assume of the future for our intrinsic value calculator, we have the PE ratio and the shares outstanding. So looking at the PE ratio, we can see the PE ratio has been decreasing basically over time, in which right now it's at about, like I said, a 22 PE ratio. And basically since 2022, it's averaged, let's say 25. So it's slightly below its average in the past 3 or 4 years. So with that being said, I think right now it's actually at a pretty reasonable price. And also, like I said, with the buybacks, they've been buying back a lot of shares since the acquisition of First Data Corporation, but they are buying back at about 4% and have increased it to about 5% as of these years. But I do think that they might slow this down, and I think the only reason they're actually buying back shares is because of the acquisition of First Data, because they diluted shareholders by a huge amount. So they're trying to buy back shares back to previous levels. So with that being said, taking a look at my intrinsic value calculator for the future PE ratio, for a company that's growing 7% each year, with the stock market at a 25 PE ratio right now, I think a fair PE ratio could be 22 for Fiserv just because of 7% revenue growth. I think that's a little bit slow, especially compared to the market. And now for the base case, I think 24 PE ratio, in the bull case, a 26 PE ratio. Now for the shares outstanding, like I said, they're buying back at about 4 to 5% over the past few years. I still think they're going to slow that down just a little bit because I think they need to start paying off debt instead of buying back shares. I think that's the biggest problem with this company. I would like to see them slow down the buybacks to maybe 1 to 2% each year. But they still are returning good amounts of money to the shareholders with these buybacks. And nonetheless, with the shares annual change, on the bear case, let's say they buy back 2%, and on the base case, say they buy back 3%, and for the bull case, say they buy back at a whopping 4%, we can see that actually with the base case, I think you can make up almost 15% on this company. With the bear case, I think you can make about 6.5%, and for the bull case, you can make almost 23%. So me personally, I'm actually going to do a little bit more research on this company, and I'm actually very interested right now, and I just need to do a little bit more research into this company. And the only red flag I have that I see with this company is the amount of debt that this company has, but it does make sense with the acquisition, so it still could help the company in the future. But nonetheless, honestly, this is a very interesting company that I might be purchasing soon. So thank you guys for watching this video. Please comment down below what stocks you want me to analyze next and give me some feedback on this video. Please like and subscribe, and thank you guys for watching. See ya.